Today we're going to look at the company InterParfums, headquartered in the United States and in France, and traded on Nasdaq Stock Exchange, under the ticker IPAR. Please stay tuned for the important disclosure information at the conclusion of this video. InterParfums began its journey in 1982 when founders Jean Matter and Philippe Bennisson established the company with a vision to bridge the gap between mass-market scents and high-end couture perfumes. Initially operating under the name Jean Philippe Fragrances, the firm focused on a capital-light licensing model that allowed fashion houses to outsource their fragrance development while maintaining brand integrity. This strategic approach led to an initial public offering on the Nasdaq in 1988, providing the necessary capital to shift from budget-friendly scents toward the more lucrative prestige market. A pivotal turning point arrived in 1991 when the company acquired a controlling interest in the French firm InterParfums, effectively establishing a powerful European operational hub. This acquisition was followed by a landmark licensing agreement with Burberry in 1993, which propelled the company into the global luxury spotlight and served as its primary revenue driver for nearly 2 decades. In the years since, the company has continued to refine its portfolio, famously navigating the 2012 exit of the Burberry license by rapidly diversifying into other premium partnerships like Montblanc, Jimmy Choo, and Coach. Today, InterParfums remains a leader in the fragrance industry, recently expanding further through high-profile integrations of brands such as Lacoste and Roberto Cavalli in 2024, continuing its legacy of turning fashion equity into global olfactory success. InterParfums operates an asset-light business model centered on the prestigious world of fragrance licensing. Rather than owning the core brands themselves, the company partners with legendary fashion, jewelry, and luxury houses to design, manufacture, and distribute scents that embody each brand's unique identity. By acting as a specialized general contractor, InterParfums avoids the heavy capital costs of owning factories. Instead, it focuses its investment on creative development and aggressive global marketing. The business is strategically split into 2 primary operational hubs that cater to different market nuances. The European-based division, headquartered in Paris, manages ultra-prestige licenses such as Montblanc, Jimmy Choo, and Van Cleef & Arpels, accounting for roughly 70% of total revenue. Meanwhile, the United States-based division in New York handles lifestyle and masstige brands like Guess, Coach, and Abercrombie & Fitch, which provide a high-volume balance to the European luxury portfolio. The company's customer base is truly global, with products sold in over 120 countries. While North America remains their largest individual market, representing nearly 40% of sales, they maintain a dominant presence in Western Europe and are rapidly expanding in the Asia-Pacific region, particularly in China. By targeting affluent individuals and aspirational buyers through high-end department stores, specialty retailers like Sephora and Ulta Beauty, and a robust travel retail network in airports, InterParfums effectively monetizes luxury brand equity on a massive international scale. Over the past 2 decades, InterParfums has demonstrated remarkable resilience and a unique ability to navigate tectonic shifts in the luxury fragrance industry. The company's early history in this period was defined by its deep reliance on a single massive license that anchored its European operations. This period saw steady growth as the firm capitalized on the rising global demand for prestige scents, particularly within traditional retail environments and emerging markets. However, the most significant test of the business model arrived in the early 2010s when its largest partnership was terminated. Instead of retreating, the company executed one of the most successful strategic pivots in the beauty sector. By utilizing the substantial cash infusion from the contract termination, the leadership team rapidly diversified its portfolio. This transition moved the company away from dependency on a single brand and toward a more balanced stable of diverse luxury licenses. During this phase, the European hub successfully integrated iconic jewelry and fashion houses, while the American division began to find its stride with lifestyle brands that appealed to a broader consumer demographic. The latter half of the last decade saw a dramatic acceleration in scale, particularly as the American operational hub evolved from a secondary revenue stream into a formidable growth engine. This internal balance allowed the company to weather global economic fluctuations more effectively. Even during the unprecedented global lockdowns of 2020, which temporarily shuttered physical retail and halted travel, the company managed to maintain its operational integrity and rebounded with record-breaking momentum the following year. In the most recent years, the company has entered a phase of peak expansion. By securing massive, world-renowned athletic and lifestyle licenses, InterParfums has significantly increased its market share in the prestige fragrance category. Today, the organization operates as a truly global powerhouse, with its European division surpassing a major revenue milestone and its American division consistently contributing a substantial portion of the total business. This 20-year trajectory highlights a transformation from a specialized licensee into an essential global partner for the world's most prestigious luxury brands. InterParfums has spent the last 2 decades refining a business model that prioritizes agility and brand equity over capital-intensive infrastructure. The financial data from the mid-2000s reflects a company that was already established as a specialist in the luxury fragrance market, operating with high gross margins, but with a revenue base that was heavily reliant on a small number of superstar licenses. During this initial phase, the cost of goods remained relatively stable as a percentage of sales, as the company efficiently outsourced manufacturing while keeping tight control over the creative process. The start of the 2010s marked a historical crossroads for the organization. The conclusion of its most significant licensing partnership led to a temporary compression in total volume. However, the true strength of the company's cash management became evident during this transition. Instead of seeing a collapse in liquidity, the company utilized the payout from the contract termination to immediately reinvest in a more diversified stable of brands. This strategic maneuver shifted the weight of the company toward a portfolio approach, reducing the risk associated with any single license and setting the stage for a prolonged era of compounding growth. In the subsequent years, the company's expenditure profile evolved to support this broader portfolio. Sales, general, and administrative expenses became the primary lever for growth, as InterParfums invested heavily in marketing and global advertising to build the presence of its newer brands. This increased operational intensity was balanced by a highly disciplined approach to capital expenditures. Because the company does not own large-scale factories, its maintenance costs remained low relative to its peers, allowing a significant portion of its operating income to convert directly into free cash flow. This lean capital structure is a hallmark of the InterParfums model, enabling it to maintain a healthy balance sheet even while paying out dividends and funding new license acquisitions. As the company looks toward the future, the financial trajectory suggests a business that has mastered the art of masstige and luxury fragrance licensing. By maintaining a dual hub system in Paris and New York, the firm captures both European prestige and American lifestyle markets, creating a diversified revenue stream that is as geographically broad as it is brand diverse. The resulting cash flow profile is one of a high-quality, high-return business that generates significant excess capital, positioning it to continue its role as the preferred partner for the world's most iconic fashion and luxury houses. Over the past 20 years, InterParfums has meticulously managed its capital to transition from a boutique licensee into a global fragrance powerhouse. The company's financial philosophy is characterized by a fortress balance sheet approach, maintaining high liquidity levels to remain opportunistic in a competitive luxury landscape. In the early years of this analysis, the firm focused on consistent, moderate dividend payouts while keeping debt levels extremely low. This conservative stance ensured that the company could weather the cyclicality of the fashion world without compromising its operational flexibility. A defining moment in the company's capital history occurred in the early 2010s, following the exit of its largest licensing agreement. The resulting cash infusion fundamentally altered the scale of the balance sheet. Rather than distributing the entire windfall immediately, management retained a significant portion of this liquidity, creating a massive cash reserve that allowed for a rapid and aggressive diversification of the brand portfolio. This period saw the company move from a net debt position into a significant net cash position, providing a safety net that few competitors could match. The middle of the last decade saw a shift toward more complex strategic investments. The company began deploying its accumulated capital into outright brand acquisitions and the purchase of long-term global licenses that required significant upfront commitments. This era was marked by a spike in long-term financing arrangements as the firm structured its debt to align with the extended life cycles of these prestigious new partnerships. Despite the increase in interest-bearing debt, the company maintained a high interest coverage ratio, as the cash flow generated by its core operations expanded in tandem with its growing brand list. In the most recent 5-year cycle, the capital allocation strategy has become increasingly multifaceted. The dividend has evolved from a small yield into a core component of the total shareholder return profile, reflecting the maturity and consistency of the company's owner earnings. Simultaneously, the board has become more active in share repurchases, utilizing market volatility to retire shares when valuations appeared attractive relative to long-term growth prospects. This dual approach of returning capital through both dividends and buybacks demonstrates a high level of confidence in the sustainability of the underlying business model. InterParfums is defined by its remarkable leadership stability, having been steered by its original founders for over 4 decades. The company is led by Jean Matter, who co-founded the firm in 1982 and has served as the chairman of the board since its inception. Matter officially assumed the role of Chief Executive Officer in January 1997. Under his guidance, the company has grown from a classroom business idea into a global leader in licensed luxury fragrances. Matter is based in New York and directly oversees the U.S. operations, which have become a significant driver of recent growth. The executive compensation structure for the leadership team is straightforward and heavily weighted toward cash performance. Jean Matter's base salary is $1.2 million, with his total compensation reaching $3.6 million when including bonuses and other incentives. This alignment of interests is further reinforced by the company's unique ownership structure, which is characterized by high insider conviction. Matter and his co-founder, Philippe Bennisson, collectively control approximately 44% of the company's outstanding shares. Institutional investors also play a significant role in the ownership base, holding approximately 55% of the stock. The liquidation value is estimated at $437 million, or $13.64 per share. Let's build a scenario-based dividend discount model. In the bull case, the company leverages its massive cash reserves to transition from a licensee to a dominant brand aggregator. The primary catalyst is the successful premiumization of the newly acquired Lacoste and Cavalli lines, alongside the potential acquisition of a Tier 1 fashion house fragrance license. Over the next 20 years, the company benefits from a structural boom in the Asian middle class, which views prestige fragrances as the ultimate entry point to luxury. High operational leverage allows cash flow to grow faster than sales, fueling aggressive dividend hikes and massive share buybacks that significantly reduce the float. The base case assumes the company continues its current trajectory as a highly disciplined, middle-of-the-road luxury partner. Growth is driven by the steady 7% long-term historical average of the fragrance market and the periodic addition of mid-sized licenses like Nautica and David Beckham. The company maintains its dual-hub efficiency, balancing New York's lifestyle focus with Paris's prestige craftsmanship. Dividends grow in line with earnings, and the company remains a favorite for institutional investors seeking steady income and low volatility. Strategic acquisitions are infrequent and targeted, preserving the fortress balance sheet. In the bear case, the company faces a squeeze from two sides: increasing competition for licenses and rising raw material costs. The primary catalyst is a shift where major fashion houses increasingly bring their fragrance operations in-house to capture full margins, leaving InterParfums with lower-tier brands. High inflation in essential oils and packaging materials erodes margins, while a prolonged downturn in discretionary spending slows top-line growth. Capital allocation shifts toward defensive debt management rather than shareholder returns, and the dividend growth slows significantly as the company struggles to replace aging core licenses. In the bull case scenario, we assume the following: revenue growth at 10%, operating cash flow margin at 17%, capex growth at 8%, stock-based comp growth at 10%, dividends growth at 13%, stock repurchase growth at 6%, acquisition spending in the next 20 years at $1.5 billion. Stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7% dividend model yields $123 worth of value per share in 20 years, $268 in 30 years, and $525 in 40 years. In the base case scenario, we assume the following: revenue growth at 7%, operating cash flow margin at 14%, capex growth at 5%, stock-based comp growth at 7%, dividends growth at 8%, stock repurchase growth at 4%, acquisition spending in the next 20 years at $800 million. Stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7% dividend model yields $73 worth of value per share in 20 years, $118 in 30 years, and $171 in 40 years. In the bear case scenario, we assume the following: revenue growth at 3%, operating cash flow margin at 11%, capex growth at 2%, stock-based comp growth at 4%, dividends growth at 3%, net stock repurchase growth at 1%, acquisition spending in the next 20 years at $200 million. Stock repurchases assumes price-to-sales ratio of 2. With this discounted at 7% dividend model yields $44 worth of value per share in 20 years, $57 in 30 years, and $67 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.